many people have the understanding incorrectly where if the Fed's going to raise 25 basis points, say on the Fed funds rate, that means mortgages, whatever, are going to move up exactly 25 bips. And so how does that actually, what's the actual impact? How would you explain to somebody?
Yeah. So the Fed, basically they can do two things, or as of now, they're doing two things. They change the federal funds rate, and then they can do the QE thing. What we're talking about now is really the federal funds rate, right? Which is an overnight rate that banks can lend to each other, or they can go to the Fed to get that money. So the federal funds rate essentially pins the short end of the yield curve pretty close to wherever they're going to set that federal funds rate, because you could either go to them or you could go to a repo market or whatever. So, 3 months and under, that stuff's going to track very closely to the federal funds rate. Up to about 2 years, you'll still see a really good correlation on the yield curve. Once you get to like 5 to 7 years, it starts getting pretty murky.
And we're talking about the treasuries. So
treasuries,
2-year
right.
treasuries, 5-year, 7-year.
Right. And by the time you get to like a 10-year treasury up to like 30, there's very little, if any, relationship between what the Fed's doing with the Fed funds rate and what's actually happening on the long end of the curve. And then you get into, on top of that sort of risk-free curve, there's a spread associated with all those other loans. So whether it be a mortgage loan or a business loan or a business issuing bonds, the lender's going to bake a spread in on top of that risk-free rate to compensate them for making a loan to a borrower that carries risk. So those are the components that are going to move around when the Fed raises rates. But you can't think of the term interest rates as like one singular thing. They raise one particular rate, which affects some other rates differently than other rates, but it's not by any means like a one-to-one relationship. And I tweeted about it. I actually posted, who doesn't think the Fed controls the 10-year rates? The Fed, and I linked to an article on the Federal Reserve website that actually showed that where they say the impact on the 10-year, you can't really see it based on what they're doing with the Fed funds rate. So the 10-year rate is really based on the economy's expectation or the market's expectation of economic growth and inflation. So it's kind of like what you're seeing now, right? We just saw a big CPI number come up, inflation's coming up. The 10-year actually went down because, the market is anticipating, yes, the Fed's going to raise the short end higher, but going forward, that's going to mean economic growth is actually lower and the prospect for inflation continuing higher is actually less. So you're getting the yield curve inverting for that very reason. So, in that instance, it's a good example of how, the Fed's certainly not pushing the long end up at all.
Right. Yeah, it's interesting. Even when, and usually the context, and yeah, that was the tweet I was referring to, or that I thought was great because I didn't have a source to point people to. I just explain it. But now it's like, well, here, take a look at this article from the Fed where they say they don't even do it. But also, right, to your point where that's not, you're taking out a commercial loan and you're thinking the Fed's is moving your rate in a one-to-one relationship. There's not, usually these commercial loans are more priced off of either where, let's say, like the 10-year treasury is plus a spread, or some of these, they're really more the end lender or buyer of it. They're also looking at investing in commercial bonds. And so corporate bonds. And so you have, there's a relationship with that. That's probably more indicative of what your rate would be. And so doesn't have nearly as much to do with the Fed. And it has, and also too, like rates just ran up. So like, then depends on what your bank's doing or your lender. Like, are they going to widen their spread or are they going to reduce it?
Right.
So I talked to some banks recently and they're saying we're tightening our spreads. I don't know if it's believable or not, but they're like, the rates are so high. We're trying to do something here to make it make sense to, take a loan from us.
Right.
So then that, if you don't know what's going to happen with that component either. So there's a lot of moving pieces to your rate.
Yeah, exactly. And you brought up a good point too about the way banks will treat that spread, right? In a situation where the banks are perceiving that there's a lot more risk out there in the economy, that spread might widen. But right now there's a ton of banks out there with a ton of money to lend, right? So as the underlying treasury goes up, if they want to stay competitive, they're going to lower those spreads so that the all-in rate actually doesn't go up as much as you would think either. So a million moving parts, really complicated, and the Fed has very little to do with it at that end. Now, if you have a loan that's based on SOFR rate, right, that SOFR rate is another overnight rate that's going to track really closely with the Fed funds rate. So if the Fed raises the Fed funds rate, that SOFR rate is going to go up in almost a one-to-one relationship. But then still, there's going to be a spread over the SOFR rate. The caps that you might have to buy with a floating rate loan are going to change. So your all-in borrowing cost still isn't going to change, but on those, variable rate loans, you will see a closer impact. But once you get to the stuff that's priced off of the 10-year, there's no point in even really trying to think about what the Fed funds rate is.
And then, so longer term commercial loans, so on investment real estate, let's say, what do you think those, if they're tied to anything, probably most closely to 10-year treasury or the treasury that corresponds with the loan, what do you think would be the answer on that?
Yeah, it's usually, the banks usually will quote you, right? Like a 10-year treasury plus 160 over or something like that, right? So yeah, you have that base component, which is whatever risk-free rate they're going to use, and then whatever spread they're going to tack on. So yeah, if you're looking at a 10-year loan, it's going to be the 10-year treasury, and then based on supply and demand factors and risk tolerance, what's the spread going to be over that? Basically, is the way you think about it.
Yeah, it makes sense. Yeah, and then we've done on some deals like things we're going to hold longer term, loans that have swaps on them, and so that a lot of times you're being quoted as this year. Let's say you're doing a 5-year loan, it's the 5-year swap rate,
right?
Plus plus the spread,
right?
So that's why I've never. Sometimes I feel like it's right tied in with the 10-year treasury, and that's how I used to think I was pricing my agency loans, Freddie and Fannie, where they'd be look at the 10-year and that's roughly what happened to your rate. But then I feel like that was not as obvious of a relationship maybe anymore for me, at least. I don't know if that's.
Yeah, well, it depends, right? If you're doing 5-year loans or 7-year loans, it's going to be more based on that other piece of it too. And swap rates don't always behave the same either. So it all kind of depends on the underlying structure of your specific deal.
Yeah, it makes sense. Yeah, and then for any thoughts on? So you mentioned SOFR. So a lot of these floating rate deals, the index that they were used, so for variable rate loans, switched from LIBOR to SOFR. That's something I haven't studied up on the differences between the two. Is that you got any knowledge of that?
I don't have any super useful insights on that. I haven't looked at specifically what changed, but I think the basic idea is the same, and it's just looking at sort of those short-term lending rates between banks and then pricing loans off of that. So I think they behave relatively similar to each other, and it's probably just mechanically slightly different. But for dumb real estate guys like us, probably doesn't make a big difference.
Yeah. Okay. No, I know. I didn't study up on the difference. I know this is just if you want to do that type of loan, this is what everyone's moved to. I did study up on the different types of SOFR. There's some loans are done where it's the rate's based on the 30-day average of SOFR.
Right.
Then there's a rate called term SOFR. I saw something quoted with daily SOFR. And really, I think they all kind of, you end up getting the same thing. It just kind of depends where you start. Like if rates are rising, either probably the 30-day average is going to be the lowest because you're grabbing some rates from before when they were lower. But I don't know if that ends up really mattering because whenever rates come down, your rate will stay higher longer. I would think it's got like a partial lag on that.
Right. Yeah, it's almost like the preference of the lender, basically.
Yeah. Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.